Perfect. Thank you. Jim, can we get a mic check, please?
Are you asking for me?
Yes, sir. Thank you.
Sure. I like Jason's headphones. Are you in a cockpit?
No, but I'm in a condo with my wife and my niece is here, and so you don't all hear me.
None of that.
Chairman, I show it's 10 o'clock.
Oh, that's interesting. So do I. Okay, it is 10 o'clock, and since we are back in the virtual mode, I have a required statement that I have to read. Thank you for joining us for the video conferenced employee retirement system meeting. We have a few announcements to make regarding the video conference meeting. If the video conference is disconnected at any time during the meeting shall be stopped and reconvened once the connection is restored. If communications are unable to be restored within 15 minutes, items remaining for consideration will be continued to today, March 11th, 2021 at 11:30 a.m. via teleconference. The agenda and documents are located on okc.gov. Anyone wishing to speak about an agenda item, public hearing, or to speak under citizens to be heard, please call 405-297-2391 or text 405-219-7927. Please provide your name, phone number, the item number, and the reason you wish to comment. If you call in after your item has been heard, you will be allowed to speak under citizens to be heard. Speakers will be allowed 3 minutes to comment. I ask that all participants except board members keep their phones on mute until they are recognized to speak. Board members will be allowed to ask questions or comment at any time during the meeting. So with that, I will call the meeting to order. And Madam Secretary, do we have a quorum?
Yes, we do.
Very good. Okay. Before we move on, I would like to formally welcome our newest member of the board, Mr. Sri Janata. It took a while to get him appointed, but we're very glad that you're with us. And I'm sure that there will be some orientation information provided if it has not been already. So again, welcome. Moving right along, item number 2 on the agenda is to approve the minutes of the meeting of February 11th, 2021. I have a motion and a second. Please record your vote.
Trustee Culver, how do you vote?
Yes.
Trustee Janata, how do you vote?
Yes.
The item is approved. Item number 3 on the agenda is the consent docket. We have 2 items. We can take those with one motion. I have a motion and a second on item 3. Please record your vote.
Trustee Culver, how do you vote?
Yes.
Trustee Janata, how do you vote?
I have not reviewed it yet, so I haven't voted it.
Do you wish to abstain?
Yes, please.
The item passes 9-1. Item number 4 is to ratify approvals. We have 3 items. We can take those with one vote. Have a motion and a second on item 4. Please record your vote.
Trustee Culver, how do you vote?
Yes.
Trustee Janata, how do you vote?
Yes.
Item 4 is approved. Item number 5 is to approve the claims docket.
I'm sorry, Trustee, Chairman, it doesn't look like your vote on that last
Oh,
one.
I'm sorry.
Let me open that back up for you.
Getting ahead of myself. There we go.
There we go.
Items approved. Now we can move on to item 5, which is to approve the claims docket. I have a motion and a second. Please record your vote.
Trustee Culver, how do you vote?
Yes.
Trustee Janata?
Yes.
Item 5 is approved. Item 6 is to approve the following applications for service retirement. We only have 4 this month. I have a motion and a second. Please record your vote.
Trustee Culver, how do you vote?
Yes.
Trustee Janata?
Yes.
Item is approved. Item number 7 on the agenda is to receive the report of death, authorize payment of the $5,000 death benefit, and approve continuation of the pension to spouse. I have a motion and a second on item 7. Please record your vote.
Trustee Culver, how do you vote?
Yes.
Trustee Janata, how do you vote?
Yes.
Okay, item number 8 is to receive the report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. I have a motion and a second on item 8. Please record your vote.
Trustee Culver, how do you vote?
Yes.
Trustee Janata, how do you vote?
Yes.
Item is approved. Item number 9 on the agenda is to receive the report of death, authorize secretary to make necessary changes to conform on the following. I have a motion and a second on item 9. Please record your vote.
Trustee Culver, how do you vote?
yes,
Trustee Janata, how do you vote?
Yes.
Item is approved. Item number 10 is to receive report of death, death of employee while in active service, approve pension to the spouse. I have a motion and a second on item 10. Please record your vote.
Trustee Culver, how do you vote?
yes,
Trustee Janata, how do you vote?
Yes.
Item is approved. Item number 11 is items for individual consideration. Item 11A is to approve professional services agreement with BT and Company PA for professional accounting services. I've been informed that there is a typographical error in the agreement. It is on page 2, under section 2, item 2B, where we will need to amend it to read minimize as opposed to maximize. So the chair needs a motion on that amendment.
I'll make that motion, that item on 2B, we change the wording for maximize to minimize.
I have a motion and a second on the amendment. Please record your vote.
Trustee Culver, how do you vote?
yes,
Trustee Janata, did you get your electronic voting up? Perfect.
Finally, got it.
Item is approved. Now, Madam Secretary, do we need to vote on the amended item, or did that action take care of it?
Should vote on it.
Need to vote on it now.
Okay, now I will entertain a motion to approve the agreement as amended. I have a motion and a second on item 11A as amended. Please record your vote.
Trustee Culver, how do you vote?
yes,
Okay, the item is approved. Item 11B is to approve personal services contract for retirement system specialist position. Just to bring everyone up to speed, as I mentioned at the end of our last meeting, we went through the selection process. The initial applications were screened by the Human Resources Department. We ended up doing a number of folks on the oral review board process, which produced, I believe, 5 finalists, which Regina and I did second interviews with, and we have made a offer of employment, and he has agreed with Michael Truitt. Michael currently works for the city planning department, but prior to coming into the city, he worked, I believe, for close to, if not over 30 years with the Oklahoma State Department of Health. And both Regina and I think he is going to be a great asset to the ERS office. So this is his contract. So the chair will entertain a motion if we don't have any questions. I have a motion and a second on item 11B. Please record your vote.
Trustee Culver, how do you vote?
yes,
Item is approved. Item number 12 is our investment consultant report. Item 12A is the monthly investment report. Good morning, Jason.
Good morning. Sorry, I was struggling to find the unmute button.
Unmute.
So I'll share my screen if that's okay.
Go right ahead.
Okay. Can you all see that?
Yes.
Yes.
Okay, thank you. Well, good morning, everyone, and welcome to Trustee Janata. Nice to virtually meet you. I
Likewise.
apologize, not there in person. As mentioned, my name is Jason Poulos. I'm with Asset Consulting Group. We're the strategic investment consultant to the plan. We've worked with the city and retirement system since, I think, 2003. So while we don't manage the money, we oversee the managers and assist the board and all things related to the investment function. So this morning, just a few items. The February report, we are reflecting the modified target guidelines that were discussed last month and just theoretically in terms of asset allocation. So this reflects what you intend to adopt as your new target allocation, which is the next item, actually ratifying the modifications to the policy. But these numbers and the targets do reflect those changes as if they've already happened. So you see you're at a little bit over the 65% target in equity as equities have continued to do well, slightly over the fixed income target of 20%, and that's been reduced by 5%. And then real estate continues to be underweight as that's an area that's a little bit more difficult to get money to work in the less liquid and illiquid strategies that we're utilizing, particularly in the opportunistic space, which these are typically closed-end funds, much like private equity funds that you make commitments to and they call down capital over time. As you all will recall, you did make a commitment to the Starwood real estate fund in 2020, and that was in the amount of $15 million, and none of that has been called yet. We would expect them to start calling capital in the next several months. But overall, what is overweight within the broad categories, U.S. equities, large cap and small cap, are pretty significantly overweight. A big part of that is the underweight to private equity. So also this is reflecting a change that was discussed last month, increasing your target in private equity from 5 to 10%. That will take some time, as you know, building up private equity, just like the opportunistic real estate. It takes time to build up to those targets. We can't just move money from your liquid asset classes into illiquid markets like private equity and opportunistic real estate. We make commitments to funds, and it takes a number of years to get up to those targets. So as we look at the policy, we're also proposing some modest tweak to the language explaining where that unfunded portion of the private equity should reside. And we're suggesting that resides within the large cap U.S. portfolio. In terms of performance, another good month on a relative basis and an absolute basis. The total fund was up over 2% in the month of February, as we saw fairly strong returns in the beginning of the month, and then a little bit of weakening toward the end of the month as we started to see interest rates rise, which really had an impact on some of the names that had done so well in 2020, the mega cap growth, U.S. large cap growth stocks and technology specifically. You started to see some weakness and sell off in the second half of February. Let's bounce back a little bit this month. I'm just looking at the NASDAQ's up over 2% today again, as those names are bouncing back. But really what we've seen since mid-June and really more pronounced into October and November of 2020 was a rotation out of some of the big growth names and more tech names that did so well in the early part of the pandemic when people were working from home and remotely and not really knowing when the end of that was in sight, putting a lot of pressure on more economically sensitive and value sectors of the market, which had really been going on for some time. Since November, we've seen a major rotation into value and more economically sensitive sectors, and it's certainly seeing that impact in your portfolio as your value managers are starting to do very well. But as we look at this on a 1-year basis, all of your asset classes are outperforming by a pretty significant amount. So while the total portfolio is up 24% gross of fees year over year, 23.6 net of fees, your policy index, which represents what the asset allocation would suggest, up 19.9%. So net of fees on a trailing 1-year basis, we've outperformed by about 3.4%. So really good excess return. And that's coming from, some of it is we're a little bit overweight to US, which has helped. But really at each asset class and then ultimately the managers really getting some nice outperformance. So within large cap, as I mentioned, your large cap portfolio outperformed by 4%. Really in the second half of the year, that was in tech. Your large cap is predominantly, it's about 50% pure passive and 50% in tech, which is a benchmark risk controlled strategy. They're not doing fundamental research. It's a mathematical volatility capture strategy, which sounds pretty complicated, but really what they're doing is constructing a portfolio utilizing the stocks in their case, the Russell 1000 index, and they'll do slight over or underweights of individual positions within that index based on the volatility of their price action, which tends to lead them to overweighting smaller cap companies within the large cap universe. And in the second half of the year, the smaller capitalization companies have done significantly better. And so that's where you're getting that excess, pretty significant excess return in an asset class where we're really just trying to get the market return at a very low cost. Your small cap portfolio, combination of two managers at growth and value, up 50% year over year through the end of January. No doubt the benchmark Russell 2500, which is small and mid cap names, very strong performance. Much of that coming in the second half of the year, as I mentioned, really from July on. But you're seeing some pretty nice excess return there as well in a strong market. Long short equity, which is designed to be a hedge. So we really have this in the portfolio to provide equity-like returns, but with about 2/3 the volatility or risk. Generally speaking, we would expect this to be a headwind when markets are so strong, and to provide protection when markets are going down. 2020 was a really good example. We did well on the downside in the first quarter of the year. The Mauna Kea platform did provide quite a bit of protection. It was down about half as much as the long-only markets. But really the second half of the year, as equity markets bounce back, we've got really good participation on the upside. And this is something that we were looking for when we moved from the traditional fund of funds of K2 to this Mauna Kea platform, where we were able to customize the allocation a little bit more and the risk. One of the things and criticisms of hedged strategies over the last 10 to 15 years is the more diversified you are, while you are mitigating risk, we're putting a governor on the upside. So we've now constructed this portfolio to have about a 0.6 to 0.65 beta or sensitivity to the equity markets, which is about double what it was in a fund of funds approach. But it's much more consistent with what we're looking for longer term. So we're still getting the protection in down markets, but to be up close to 32% and really outperforming the long only global benchmark, the ACWI, in that period that was up 30% is we're really pleased with that. Your private equity portfolio up 14% year over year. This is going to, 1 year measurement of private equity is really not meaningful. Longer term, much more impactful. We would expect to get a premium to public markets over long-term time horizons. In the short term, it's going to lag. When markets are way up, public markets are way up, private equity tends to lag because it's not being marked to market on a regular basis. So pricing information lags as well. Also, within your private equity portfolio, you made a number of commitments in 2020. So you've got several commitments to funds that really haven't put capital to work yet. So we're pretty early on in the development of that program. And now we're at about a 50% weight to the new target of 10%. International and developed markets, which is, again, we're using a combination of a growth and value manager, Lazard, a more value biased manager, and Harding Loevner, a more growth oriented manager. We've got pretty nice excess return here as well, about 4.5% on a trailing 1 year basis. So really nice gains from both of those managers. And then emerging markets, here we have two managers. One is the Wells Berkeley Street manager, which is a core manager. They'll invest in mid cap to large cap emerging market companies, and then complemented with Wasatch, which invest in more small cap emerging market companies with market cap under 2 billion. That's intended to be only about 20% of this 6% allocation. So it's the highest volatility next to, or highest risk equity asset class, probably next to private equity in your portfolio, but really designed to be able to generate some excess return over time. And we've really seen that over the last year from that small cap portfolio. The fixed income allocation, certainly February and into March has been a challenging time, which we've anticipated. As yields bottomed out in 2020, the 10-year Treasury down around 0.7%. When we talked about asset allocation last month, we talked about how challenged fixed income investments will be going forward to eke out return because we're starting from such a low base in terms of yield. We did see the 10-year Treasury move pretty dramatically in the month of February, up to north of 1.5%. As yields on bonds go up, bond prices come down. As we've talked about considerably, your fixed income portfolio, we have a number of other return drivers within fixed income other than just interest rate sensitivity. So corporate bonds, credit, currency through non-US bonds, developed markets and emerging market debt, and floating rate debt as well. So really, as we look at this picture on a 1 year basis, that 6% return from your overall fixed income portfolio relative to the ag is, while on an absolute basis, it's fairly modest compared to the equity components. On a relative basis, it's really good excess return that we're getting. And we don't expect to get 4.5% excess return from your bonds relative to the benchmark, but we would expect 50 to 100 over time based on the construction. We just have a lot less sensitivity to interest rates, which was a headwind in the 2019 and first quarter of 2020 as we saw yields plummeting. But as a long-term investor where you have a 7% return hurdle, we need to be doing some things in bonds that give us a little bit more ability to generate return without taking on too much undue risk or volatility. And finally, the real assets portfolio. This is a roll up of your core real estate, which is the Morgan Stanley Prime Property Fund, as well as the opportunity, the private market real estate, where you've had 3 commitments going back about 6 or 7 years now. Primarily, this return is coming from the Morgan Stanley Prime Property Fund, which is done, again, on an absolute basis compared to equities. It doesn't look great in the near term, but certainly on a relative basis, they've done very well relative to their peers and the benchmark. Over time, the real asset allocation is expected, it's within the strategic allocation to provide an inflation hedge, a premium return to fixed income with less risk than equities. And it's been able to do that certainly since you've had it within the portfolio. So again, really the portfolio continues to perform well. We're really pleased with manager level performance. No issues with any of the managers. I probably went into a little bit more detail the normal month, but just trying to give Trustee Janata a little bit of background, and I will offer and work with Regina just to set up some one-on-one time if you're interested, Sri, just to give you some background and more detail.
Yeah, that'd be great. Thank you. I really appreciate that.
Paul, should I go to the next item?
Amy, do we need to just accept the report?
Mr. Chairman, could I entertain a question before we go there?
Sure.
Okay. Jason, thank you for that report. It looks like the portfolio is doing real well. I did have kind of a general question for you, that as far as risk goes, that you would see the risk potentials that we have out there, say, whether that's a business risk, an inflation risk, and interest rate risk, market volatility. Where do you see that, in this economy, what in your opinion would be our bigger risk?
Well, I'd say, we're always looking at taking a very long-term view because you're, as a pension fund, you have long-term liabilities. So when we're speaking of risk, we think of risk in terms of not meeting your return objective over the intermediate to long-term time horizon, which is, we would say at the next 10 to 20 years. So one of the biggest risks there is muted return expectations going forward because interest rates are so low and equity valuations are high right now. In the short term, we expect volatility. When we do asset allocation work, and we looked at this last month, we know that this asset mix that you have, there's about a 20% probability in any given year that you could be flat to negative returns. So we recognize that. We're doing some things within the portfolio to mitigate that to some degree with hedged equity on the equity side to try to mitigate some of the equity market risk. But I think the biggest risks that we look at is just the challenges in generating your 7% hurdle rate over long-term time horizon. So maintaining and being thoughtful about the strategic allocation. In the short term, the risks to disruption in markets are always there. There's so many we can't predict. Global economic, geopolitical issues that we don't anticipate, a pandemic that we would not have anticipated that. We saw markets sell off 30 to 40% in February and March of last year. That wasn't a risk that any of us could have predicted. But what did we do? You have a diversified portfolio across multiple asset classes that hopefully protected against that. And then the other thing that we did was rebalance back into some of your areas of the portfolio that were down the most, so that when the markets rebounded, you participated in that.
Thank you for that answer. Mr. Chairman, that's all I had on that, so that we can move on to the next item. I will have some questions if I may for the next item, but I think my answers were for this item answered. Thank you.
Okay.
Chair, you'll go ahead and take a vote on item A.
Okay, Chair will entertain a motion to accept the monthly report. Okay, I'm not,
Chairman, you may have to press escape on your keyboard for you to be able to see your Prime Gov stuff.
well, what am I doing here? Huh. Okay, I do see it. Let me, okay, we have a motion and a second. So please record your vote.
Trustee Culver, how do you vote?
Yes.
Chairman, do you have your buttons?
Yeah, but it is not functioning correctly, so I'm going to vote in the affirmative on this item. Item passes. Okay, item 12B is to adopt the amended investment policy statement that we discussed last month. Jason?
Yep, I'm trying to. What do I got to do here?
I love technology.
There we go. Okay, this is really just to reflect the the change in the asset allocation targets that were reviewed and agreed upon last month when we did the asset allocation analysis. So on page 5 of the IPS, we're just documenting, and I know this red line version is, there's a lot of slashes and marks, but this is reflecting the target, the change to the targets that were approved last month, which I believe was mix 1. We also made we're making some slight tweaks to the ranges, particularly with, we had everything was plus or minus 5%, but really for total equities, when your total equity target is 65%, plus or minus 5% is about a 7% deviation from the target, whereas in fixed income, plus or minus 5% from a 20% target is a 25% deviation. So really just with a larger allocation, you need a little bit more room on the ranges. And then the other slight change, this language in this paragraph here, that was added when you first started investing in private equity and you really had zero private equity. We indicated it was you started with a 5% target when you first introduced private equity, and it was coming from fixed income and equity as we were reducing both of those. Now, really, the unfunded portion of private equity, because we're looking for equity-like returns from private equity, we really believe it should be held within your equity portfolio, not equity and fixed income. So we're just tweaking that language a little bit to say the unfunded portion of the private equity allocation will be held within U.S. large cap equity, just as a reflection. So when you see that large cap equity is 4.5% overweight and private equity is 4.5% underweight, you're really at your targets. because it's going to take some time to get to that 10%. And then the other slight tweaks are adjusting the policy index for performance comparisons to reflect the changes in equity and fixed income overall, because that fixed income was going down a little bit and equity was going up a little bit.
Jason, this is Brent. I have a quick question. If you go back to the previous page, you're talking about the unfunded portion of the private equity. We're going to run, keep it in the large cap until we can invest it. Is that correct? This is what you're saying, right?
Yeah, I mean, from a, yes, we're not really keeping it there. It's in the other, it's scattered amongst your portfolio, but as we look at allocations, actual versus targets, we're going to not trim back large cap so much if it's outside the range, because we also know that this unfunded private equity is in there.
Right. Okay. Which leads me to you.
Really, you know,
which led me to, you were talking about when we're talking about our real estate that we invest in, and how the money, you know, we make a commitment, but then they draw down on that commitment, right? Or do we give them the funds? How does that work?
Well, it depends. The core real estate, so the Morgan Stanley Prime Property Fund, that we would consider that an open-ended real estate fund, so they can take money quarterly, and if you have the ability to get money out quarterly, so long as there's not liquidity issues happening. They do have the right to restrict redemptions or contributions based on market environment.
I was just thinking of it, say we committed $10 million to a project, and then they're going to come. What do we do with that 10 million until they ask for it? Where do we? Because we all know we don't want idle cash. So what are we doing with those funds?
Well, it's invested across the rest of your portfolio.
Okay, then we start taking it off. Okay.
Yeah. So when capital calls occur, we raise money from where whatever's overweight to fund it.
You do a little harvesting, as we call it.
Yes, because your portfolio is very liquid.
Right. Okay.
You go back to.
Okay.
We can look at this and you'll see. So you see right now we're overweight to large cap equity. But
we can't see you right now, Jason.
Oh, you can't see that?
No, we're looking at you.
Oh, sorry.
I do love the color.
Technology. You think I would be? Thank you. Lots of blue. Now you can see that.
There we
You'd
go.
think I would have learned to use this technology by now.
Really?
So real estate, while it's 5% underweight, you've got a little bit of cash, and that's that's really for operating needs. So that's, but if there were capital calls in real estate right now, or capital calls in private equity, the first source would be cash.
Right.
But if we needed to raise money, very sensitive mouse this morning. If we needed to raise money, the capital calls, you usually have a 10 to 15 day notice. If we needed to raise money, we could easily go to large cap, which is very liquid. We can raise, you can turn that into cash within a day.
Okay.
Small cap, it's probably a couple days. International equity, a couple days. Your fixed income is all within a day that you could raise cash.
Jason, what happens if there's a capital call during a downturn? Do we have time for maybe, for it to rebound or anything like that?
Well, I mean, a capital call, you're not going to have a capital call that is so significant that you wouldn't be able to raise sufficient liquidity.
Okay.
Your portfolio is so liquid. I mean, we're talking, 85+% of the portfolio is in daily liquid securities. Capital calls right now, you're
Looks like the cash is significant enough to cover a majority of that capital call if, if it all came due.
That wouldn't happen. We
Yeah.
know that you've
That would
got,
never happen.
no, you've got 36 million in remaining commitments in private equity, but so much of that is within 2020 commitments. We model this out and do a lot of work on this. This is going to be called over the next 5 to 6 years.
Okay.
That 36 million. So it's, it's really not an issue.
Okay.
That when we're doing the private equity pacing plan, we're very thoughtful about that. How much do we have to commit each year to get to our target? So since you increased your target from 5 to 10%, that dollar amount that needs to be committed each year is going up. I think it's probably going from like 25 to 40 million now. But we also stress test that to say, what happens if public markets go down by 10%? What is that going to do? Are we going to overshoot? Could we overshoot that 10% target? And right now we're trying to get to that 10% target now within 3 to 5 years. So we're very cautious as to how we're putting money to work.
If I may ask one more question, and I'm sorry, I know since this is my first meeting, maybe if we need to, have a discussion just one-on-one, that's fine. Has there ever been any discussion about allocating any specific part of that private equity or real estate to Oklahoma-based firms to kind of, to support our local business community? Has that ever been discussed?
Well, that is a discussion that comes up from time to time with public plans. The fiduciary mandate is that you earn the best possible return you can for the participants. Generally, through where that has happened, like it's called economically targeted investments. It's been where there's been some type of legislative action or that would provide for fiduciaries to make decisions like that.
Okay.
So to my knowledge, in the city of Oklahoma City and even the state plans in Oklahoma, there is not such legislation. That said, some of the state plans may have done some things in with local fund sponsors, but it's been more on a level playing field, making the decision based on that being the best available or fits what they're trying to do, but not for the purpose of saying we want to invest local.
Yeah. Okay. Thank you.
Jason, I've got a quick question for you. When in the policy on page 5, where we were talking about the unfunded portion of it going to the U.S. large cap funds or equity portfolio, I thought I understood that, and then I kind of got a little bit confused when we were talking about where the funds would come from when we get a call. What I thought I understood was being discussed is that the unfunded portion would go into that portfolio, but I think what you're saying is while that's in there, when a cash call comes, it may not come directly out of that portfolio. It would come out of other places. Could you help me out with my understanding on that?
The language there is to acknowledge that when we look at targets, we look at current versus targets, because it's going to take so long to get to that 50% or increase in your private equity portfolio. Something's going to be overweight. Things aren't going to add up. When capital calls come, ideally, capital calls, these are like 100,000 or 500,000, maybe $1 million. They're not significant dollar amounts at one time. So if there's cash, that's going to be the first place that it's from an operational standpoint, you're going to meet the capital call if there's sufficient cash. If there's not sufficient cash and we had to raise capital from somewhere, we would look at the over and underweights. Presumably, large cap is going to be overweight based on what we're doing. So it would be the source. But it could be at that moment in June of 2025, when you get a capital call for $2 million, that we've had 3 months of emerging markets going up 40%. I don't know, just making something up. So that it would be the most logical place to take it because it's overweight.
Okay.
It's really operationally, the funding of capital calls. First off, the funding of capital calls from an operational standpoint is not an issue. We look at it, and Matt, we work with Matt on what the cash flow needs are, and the cash flow needs are primarily for benefit payments and other expenses. But we recognize that there could, based on the unfunded commitments of private equity, having a little bit of cushion there within your cash is beneficial just in the event we need to meet something.
Yes, I was going to just follow up and say that. So if you look at our cash balance right now, like Jason pointed out, 10 million is about as high as that we'll get because we look at it over a few months. And most of the time, the capital calls are able to be funded through what we have available in cash. And we work with Regina to know what the pension payments are going to be and any other little ancillary payments that might have cash needs. But then we work with ACG to determine, okay, here we know what our pension payments are going to be over these next few months. By the end of February, we'll probably need to raise some cash, and we coordinate it that way. And like you said, they're rarely higher than a few $100,000, and we have multiple weeks to get those processed. It's not like we need it overnight. There's usually a 2-week, 3-week leadway where they say, here's when the capital call is going to be due. And so that's when we're able to do that.
Okay, that helps. Here's what I think I heard is that in the policy statement that we have, we're just simply saying that unfunded portion is going to be recorded or more or less placed in those U.S. large caps. But that doesn't necessarily mean that when we have a call, that's where we go and we have to go to that to get that out there. That's just going to affect our balance that we have in our portfolio weighting. What I believe I hear y'all say is that, well, if a call comes up, number one, we're going to go look at cash. And then number two, we'll look at the balancing. And if it just so happens to be that the U.S. large cap is the one that's the highest out of balance, we would look in that fund to go look at it. But it'd be primarily just on a priority of looking at the weighting within the funds. Is that, do I have that there? Is that the way that you all see it?
Yes.
Okay. All right. That helps. I don't have any other questions if y'all would like to move on.
Does anyone else have any questions regarding the,
Oh, Mr. Chairman, I'm sorry. We are on this item. We have not moved off on it. Yeah, there was some other things that I had in questions. I have some questions overall about the policy at whole. Maybe it might be best to hold that for later on because it doesn't really affect the voting one way or another on the issues we have at hand. But Jason, this might be a question for you. I'm really intrigued with this private equity investing. Looking at that, very different way of investing than what we have in all of these other things that we're into. And so I apologize ahead of time that I'm going to be a little chatty today just because I have an interest in this. And I think it's a great way to invest. I don't have any oppositions to it. But I am looking for just a better understanding, as a new trustee, just a better understanding of what we're doing. So first question would be, in this private equity, are we just primarily just passive investors? In other words, we're just providing the money to some private equity funds or private equity managers somewhere?
Well, that's what you do. I'm not sure the use of the term passive.
Well,
in
in other
our
words,
vernacular is a little
we're
bit
just-
different.
We're
'Cause
just providing the money. We don't have any management oversight in the companies or really providing any recommendations to any of the managers that might be involved with this if we are using managers on this. In other
correct.
words,
And you don't
we're just money.
with any of the managers that you use, you don't have any, your authority is to take the money away or either fund them or take the money away. With private equity, it's a little bit different in that you're making a commitment to a fund. So a promise to fund that fund over its life. You have less ability to take that money away. Because it's illiquid investments to get out of a fund. You're really making a long-term locked up investment with private equity. You fund it, they invest it, they sell the companies, and they send the money back to you. So you don't have control over the timing of when the money goes in or comes back with beyond the terms of the agreement of that limited partnership. Whereas with your large cap equity manager, you make a decision to fund them tomorrow. And if you want to make a change, you can completely terminate and get your money back, pursuant to the terms of that agreement. So it's a little bit different, but you have no authority to direct what your managers, what companies they invest in or management. But to use the term passive or active, your private equity investments are the most active investments that you're making. You're investing in funds that are then investing in companies where the manager, if you will, is very hands-on in the operation of the companies that they're investing in. They may be making operational changes or financing changes to how that business is financed, hiring and firing executives at the underlying company. So it's the most active form of investment management that you have in the portfolio.
Okay. With these investments, the private equity that we're getting into, generally those are like a leveraged buyout or a venture capital deals. Do you know with the type of companies that we're investing in, is there any way of knowing, which one of those two types of investing are we primarily in? Or is that just really something that's, it's just hard to tell what is going on with those investments?
No, we know exactly what they are. And as we bring those funds to you, and we're very thoughtful in building a program that's diversified by type of investment, by vintage year and economic cycle. So within your portfolio today, the private equity program started in 2009. Your first investment was with a fund of funds, Mesero, that it invested in 20 to 30 underlying funds, but there was 2 layers of fees. You're paying the fund of funds manager and the underlying managers that were everywhere from seed stage venture to growth equity to buyouts to secondaries. Since that time, really since 2012, we've endeavored to build the private equity program through direct fund investment, not having a second layer of fees in there. So you've made 2 commitments to Warburg Pincus, which is a global growth equity fund. So it's mid to late stage venture capital and growth equity. So not leverage buyout, but more funding private companies that are more mature. In March of 19, you made a commitment to Apollo Fund 9. Apollo is a large leverage buyout strategy. So it's going to be investing in more mature companies, more that may need more financial turnaround. They may be distressed to some degree. So it's very different than Warburg Pincus. Beginning in last year, in June of last year, you made commitments to the First Mark Opportunities Fund 3 and First Mark 5. These are it's a venture capital strategy. So a mid to late stage venture and an early stage venture strategy with a firm that has done very well. Not the funds that you're in are fairly new, but in their recent vintages, they've had successes like Pinterest, probably being one of the most notable, but certainly many others. And where Pinterest was a 100x type of return. Also in 2020, July of 2020, we did the Carvalh Credit Value Fund. This is a deep value distressed strategy, taking advantage of the market environment coming off the heels of what we saw in the early part of the year with companies' credit and bond issuance being really challenged. They can go anywhere and take advantage of deep distressed opportunities. And then finally, we did the last commitment made last year was in the Francisco Partners. You did 2 side-by-side funds with them. They are again a technology focused, specifically technology, but this is late stage venture and growth equity as well. So you're investing across the spectrum of private market opportunities and across over time, putting money to work over time. When we will, it's probably been a few months since we've done a deep dive on the private equity portfolio, but maybe that's a good education session that we'd be happy to do, maybe one-off away from the board meeting to go into more detail on the development of the private equity program.
Well, I would certainly enjoy participating in that if that ever came about. Like I say, it's a very interesting way of investing in, and I would like to know more about it. Turning over to page 17 of our policy, I think it kind of dovetails into this discussion we're having now, where we have our guidelines for private equity and venture capitals. And one thing that I noted in here was that, you know, some of the strategies that we have are very much, I think all of them but one, maybe you've touched on, seed, early and late stage venture capitals, small, mid, and large market buyouts, distressed debt. I think that second to last one you mentioned sounded like a distressed debt type of a venture that we got into. And then we have one that's the mezzanine debt. That's somewhat described between, you know, a bridge between debt and equity. Apparently there's some provisions where it's a lower tiered on your debt as far as defaults, but it's a higher level than equity, and it sounds like it has a trigger there that where you can convert that debt into equity at some point. Could you expand on that mezzanine debt a little bit? That's in our policy here, and whether or not you know we have used that type of a strategy?
So the policy is intended to be very broad to allow us to bring funds to you across the private equity spectrum. To date, you don't have any direct mezzanine debt funds. So mezzanine debt funds would invest generally alongside a leverage buyout sponsor, providing debt capital to the capital structure of private companies in exchange for interest rate payment and generally warrants or something that converts to equities. So I think, you know, these are great questions. I think we'd be happy to do a deep dive education session on private equity. It's certainly something that is utilized by many public pension funds and long-term investors as a way to enhance return. I don't think it's unique in any way, but as far as what you're doing, what the city of Oklahoma City is doing with private equity, but certainly it's a little different in understanding how it works. And we'd be happy to do a broad education session on it.
Well, I appreciate that, Jason. Like I had mentioned earlier, yes, I'd love to participate in something like that. Mr. Chairman, I had 2 last questions that didn't have anything to do with our private equity, but had to do with
a couple of the policies that we had in here that I had a general question about. We have over here on page 4, a criteria under under our policies that talks about the board may institute a securities lending program to generate additional income. And I wasn't aware of what the security lending program would be. Is there somebody that can enlighten me on that?
We can. You're not doing securities lending right now, but it would be again, it's a pretty complicated strategy that you're not implementing currently. It's just broad language that at one time you did.
Okay. Fair enough. I can delve into that later on. It sounds like, if I'm hearing you right, we're not doing that right now, so probably don't need to worry that much about that. Last question I had to do with this bullet number 7 on page 4. And Trustee Thurman, you might be maybe somebody who could help me with this. This paragraph talks about trustees, officers, employees, consultants involved with, well, basically if I have investments, say with an Edward Jones or maybe a company such as yours, where as me as a trustee, I've got investments, how would this apply to that? Or maybe it doesn't even apply to that. Can you help me with that understanding with when would I need to be concerned about my investments as to what we have in this retirement system?
If you were an employee of Intech or an employee of Times Square, or you had an ownership interest in one of those firms,
yes,
this is just a standard conflicts of interest disclosure paragraph. That's what that's getting at, that you have to disclose conflicts of interest. So if you were to vote on a firm that you were an owner of or an employee of, you would have a conflict of interest.
Okay, so
it's not about if you have investments in mutual fund that the plan also invests in. That's not the same thing.
Okay, so if I'm just holding some holdings, I've got a financial manager that I've just given them my money and they're investing it and diversifying it in certain ways. That's not what we're talking about here then.
No.
Okay, all right. Well, I appreciate everybody for letting me be so chatty today, and I think that has all of my questions. Mr. Chairman, I'll turn it back over to you.
Okay, Chair will entertain a motion on item 12B. I have a motion and a second. Please record your vote.
Trustee Culver, how do you vote?
Yes.
Trustee Madera, do you have voting buttons?
I do not.
How would you like to vote?
Yes.
Item is approved. Item number 13 is comments from board, staff, and citizens.
Mr. Chairman, I'd just like to welcome Mr. Janata to our board and look forward to working with him and continue the long-term sustainability of this program. So,
Thank you. I'm honored to be here.
I will definitely second that.
Mr. Chairman, I'd like to echo Brent's comments. Congratulations, Trustee Janata. Glad to have you on board. I'm kind of the new member on here too, so maybe we've got something in common. I'd also like to make a comment about Mr. Truitt coming on board with Regina. Regina, as you know, we were on that board, and I listened to all the interviewees, and I think you've got you a really good candidate. There were a lot of good candidates. Very impressed with the selection that you had. But certainly welcome Michael Truitt on. I think he is going to do a great job for you, and I hope that that relationship works out just as you wanted it.
Thank you. Yeah, we're really excited and he seems real excited about coming on board also.
Okay, any other comments? Hearing none, we are adjourned at 11:07 a.m. Thank you, everyone.
Thank you, Paul.
Thank you. Thank you,
Thank you
everybody.
all.
Bye.
Thank you, everyone.